Thank you. Well, thank you very much. And my goodness, it's wonderful to see you all here today. A wonderful crowd and so many friends in the room. So thank you so much for being here. I'm very happy to be in the city and to have this opportunity to speak with you this afternoon. I always find that you can feel the pulse of the global financial system here. But I have to admit, it feels a bit like an irregular heartbeat. Now, the recovery from the Great Recession has been obviously a long and drawn-out affair, with some countries emerging faster than others. And long-term interest rates, as you well know, are extremely low. And as an important benchmark, they're well below central banks' inflation targets. The financial market volatility has gone up across the board as economies and policies diverge, and as the prospect of policy normalization becomes more real. So today what I'd like to do is to consider what this means for a central issue, central bank credibility. It's something which I think we should all care a lot about. So the question is, do very low long-term interest rates and recent increases in financial market volatility represent some sort of erosion of central bank credibility? Now, I'm sure you'd be shocked to learn that I think the answer is no. I think that central banks are actually doing their jobs quite well and in a very challenging setting. But in my time today, what I'd like to talk about is what can we learn from low interest rates and this observed increase in financial market volatility, as well as what we can expect as we go forward through the process of monetary policy normalization. So let's start by looking at these extremely low borrowing costs that we see in many economies. And consider, for example, the return that one would receive today on a 10-year bond issued by any of the Group of 7 government if it was held until maturity. And as I said, investors would be accepting an annual return that is even lower than the central bank's inflation target, sometimes well below. So what's it telling us when investors are willing to receive such low returns? Now, central bank policy frameworks may differ from place to place, but the concept of inflation control is at the heart of monetary policy in most economies. So are low yields an indication that investors think that we will be unable to bring inflation back up to its target? Well, to help answer this question, we can take a quick look at the Canadian data. In a recent paper, some of our economists decomposed the yield on a 10-year Government of Canada into 3 components: long-term inflation expectations, expectations of real short-term interest rates, and the so-called term premium. Our analysis shows that Canadian long-term inflation expectations have stayed very close to our 2% target since the onset of the financial crisis. Now, this is corroborated by other methods that we have of measuring longer-term inflation expectations. And these include surveys of professional forecasters and the break-even inflation rate based on comparing nominal and real return bonds. So let me pause here just to stress a point. Why would inflation expectations be so important? Well, it's because that well-anchored expectations help promote stability both in inflation and in the real economy, as well as the financial system. Solid inflation expectations also give central banks more leeway, or room to maneuver in responding to temporary shocks, such as changes in energy prices or exchange rate movements. Evidence shows that for the most part, central banks have been doing well at keeping expectations anchored in a very challenging environment. And measured in this way, it's clear to me that credibility is intact. But we don't take false comfort from that. Vigilance is required because if long-term expectations do shift away from the target, it can be very difficult to re-anchor them. So to understand why long-term interest rates are so low, we need to look at the 2 other components I mentioned: expectations for real short-term interest rates and the term premium. Now, these components account for the full drop in long-term bond yields that we've seen since the crisis. And it's relevant to our topic today because they've also been heavily influenced by central banks as they work to meet their inflation goals in the aftermath of the crisis. So let me make 4 points here. First, expectations for real short-term interest rates depend on the level of the real neutral interest rate. That's the rate that will generate just enough savings to finance investment in the long run. Our senior deputy governor, Carolyn Wilkins, gave a speech late last year where she outlined why we should expect to see a lower real neutral interest rate globally. The reasons include slowing labor force growth. Look around you. The baby boom is over. Slower labor force growth in the major economies, that would, of course, suggest a drop in the demand for investment, along with lower productivity growth, and a very strong supply of savings from many emerging economies. This combination means that we have to start thinking about equilibrium interest rates from a much lower starting point than in the past. Second, on top of these structural factors, we've seen central banks react to the financial crisis and the subsequent Great Recession by aggressively lowering policy rates. Several central banks, including the Banque of Canada, also found themselves constrained by the effective lower bound on interest rates. And by issuing forward guidance in various forms, they were able to reduce expectations for the future level of the policy rate. And this, of course, added to the pressure on expectations for real short-term rates. Third, central bank actions and forward guidance have served to reduce uncertainty about short-term policy interest rates. That helps reduce the term premium. And fourth, quantitative easing. Quantitative easing programs employed by some central banks included purchases of long-dated bonds, and that reduces their yields. There's strong evidence that those purchases have even pulled down yields in markets that didn't have quantitative easing, such as Canada. So to sum up, to me, there are very good reasons why long-term interest rates are unusually low, but the de-anchoring of inflation expectations is not the central driver. Rather, low long-term interest rates reflect a combination of a declining neutral rate of interest and the actions being taken by central banks to foster stronger growth in pursuit of their inflation targets. And ultimately, inflation expectations and the inflation outcomes that support them are how a central bank's performance should be judged. But some would judge a central bank's credibility against a wider range of criteria, including the level of financial market volatility. Measures of volatility have risen recently in a wide variety of asset classes across a number of countries. Just to name a few: U.S. Treasuries, various exchange rates, the S&P 500. There are many factors contributing to this increase, and I won't try to list them all, but I'd like to mention four. First, the forces acting on the global economy are obviously powerful, and they're affecting many economies differently. The post-crisis headwinds to growth, including widespread deleveraging and lingering uncertainty about the future, have proved highly persistent. Furthermore, the sharp drop in oil prices is having a significant effect, and it's positive for some, negative for others. This shock, of course, surprised everybody. And the fact that it is so large and happened so quickly means that many of us have had to work hard to fully grasp all of its implications. Several central banks around the world, including the Banque of Canada, reacted to this environment with policy announcements that weren't fully anticipated by investors. The second, these forces are leading to a divergence in monetary policy paths among the big three central banks. The ECB, the Bank of Japan are implementing quantitative easing, while the Federal Reserve is beginning the process of normalizing its policy. This divergence is naturally leading to a significant adjustment in the outlook for interest rates and currencies, as well as higher volatility in bond and foreign exchange markets. A third contributor to financial market volatility is related to global regulatory reform. The Basel III and other reforms are clearly making the global financial system safer. That's job one. But they've also reduced incentives for banks and some dealers to hold inventory, act as market makers, provide a shock absorber, and function in times when volatility is high. And fourth, financial market volatility has been compressed in recent years by what I call the one-sided nature of our economic outlook. With many economies operating with excess capacity, growth remaining weak, and deflation a real threat in some places, interest rates have been expected to stay very low for a very long time. And this expectation, of course, was reinforced by forward guidance and other unconventional policies of some central banks. But those expectations are beginning to shift. The global recovery has been uneven and fragile, but it is progressing. We are approaching a transition phase, taking the first steps on a path towards normalization, if you will. Eventually, the global headwinds will dissipate, and central banks will be able to transition away from unconventional policies and return to more conventional ways of conducting monetary policy. And this will mean, fundamentally, a return to two-sided risks, not one-sided, where interest rates could rise or fall, depending on how economies evolve. And during this transition toward normal, more financial volatility is to be expected. Now, these seem to me like legitimate reasons to expect higher financial market volatility today. And is the volatility that we're seeing now abnormally high? No. While market volatility has risen recently, it has done so from historically extremely low levels. It has begun to return closer to historical averages, not abnormal levels. So is this increase in volatility actually a negative development? Well, no. Above all, volatility relates to unexpected economic developments, to which central banks will necessarily respond in order to fulfill their mandates. When shocks to the economy occur, whether positive or negative, higher financial market volatility is a natural consequence, an integral part of the economy's equilibration process. Therefore, such financial volatility is neither inherently bad or good. And if it reflects the emerging possibility that the one-sided outlook that we've been experienced for the last several years is finally becoming more balanced, then that is unambiguously good news. Still, as we begin to work through the process of getting back to normal, the question remains: if explicit forward guidance can suppress financial market volatility, why not keep using it? Well, in this context, what I mean by forward guidance is explicit statements around the future path of interest rates. Now, central banks inevitably talk about the future, and any such statement can be construed to be a form of guidance for markets. And all such forms have their uses in the right context. But I reserve the term forward guidance to mean specific comments or conditional commitments around interest rates. Now, there's absolutely no question that forward guidance is a valuable part of the central bank toolkit. It has clearly been helpful in Canada and elsewhere. But as I said in a paper published last year, we at the Bank of Canada believe that statements to explicitly guide market expectations about the future path of interest rates are best reserved for extraordinary times, such as when policy rates are at the effective lower bound, or during periods of market stress. Keeping forward guidance in reserve ensures that it will have a greater impact when it's actually employed. Otherwise, it becomes addictive, and it loses some of its impact over time. In short, to me, forward guidance is not a free lunch. It comes along with costs. So let me elaborate on this by stressing some of the points I made in that paper. Forward guidance works by taking some potential actions by the central bank off the table. A commitment not to raise interest rates for a given period or until certain economic conditions are met can flatten the yield curve and add a little more stimulus to the economy. But in doing so, this commitment creates a skewed bet for investors. Volatility falls as a result, for the time being, as market participants naturally position themselves around this bet, often using significant leverage to do so. So what happens when circumstances change, as they inevitably do? What happens when investors start to consider the possibility that the guidance will change? Well, the positions that are stacked around the central bank's guidance unwind, and all that suppressed volatility suddenly resurfaces in financial markets, often to levels that surpass historical averages. And that's when we pay the price of the forward guidance. To be sure, when the policy rate is at the effective lower bound, the benefits of forward guidance can easily outweigh the costs. At other times, though, the costs loom larger. Indeed, in normal times, when economic and financial risks are clearly two-way, there's a very basic law of economics at work. Volatility happens. It's the force of nature. Economists call this underlying fundamental volatility shocks. Unexplained shifts in consumer behavior or business behavior, or oil price shocks, or shocks from foreign economies, or even, yes, financial market shocks. This volatility has to go somewhere in the economy. Now, central banks target inflation, which means stabilizing inflation and economic growth, not interest rates. Pursuing that mandate means that financial markets usually carry more of the natural volatility that arises. Now, to make this point in its most extreme form, consider how your perfect central bank, the hypothetical, all-seeing central bank, would behave. I suppose like on Star Trek. Now, the central bank would anticipate all the shocks to the economy. They would move interest rates up and down to offset them, so inflation would always stay right on target. Now, looking at the data afterwards, we might think that all the interest rate and financial market volatility had been unnecessary because inflation was on target the whole time. In other words, perfect policymaking might look silly afterwards, simply because people can't see the underlying shocks. But the financial market volatility would be a natural consequence of the central bank's efforts to achieve its mandate. Now, of course, we haven't been in normal times for quite a while. We're just taking the first tentative steps toward normalization. And the road will not be smooth, as our recent experience in Canada illustrates. Late last year, we saw encouraging signs that the economic recovery was broadening. Stronger exports have started to be reflected in greater business investment. However, as we approached our January decision on interest rates, we had to consider the implications of the unexpected plunge in global oil prices. Now, given the importance of oil to our economy, this shock represented a significant downside risk to our projected inflation profile. It also posed a risk to financial stability through the reduction in income that would occur. Now, because lower oil prices mean lower Canadian income, around 3% at the moment, the shock would worsen the debt-to-income ratio of Canadian households, even if no new borrowing occurred. Now, we thought in January that it would be best to act sooner rather than later, given the magnitude of the shock and the immediacy of its likely effects. Indeed, oil prices were still falling and to levels below our assumptions built into our forecast at that time. Accordingly, we took out some insurance in the form of a 25 basis point cut in interest rates. And the reaction to this cut across the yield curve and in the exchange rate would then help cushion the blow to the economy from the oil price decline and help bring us back to full capacity and a sustainable 2% inflation target sooner. It would also help to mitigate the rise of the debt-to-income ratio by reducing the drop in income, although debt levels themselves could rise at the margin. Now, we knew at the time that financial markets would be surprised by the move in January, and we generally prefer to avoid surprises. But we will do what is necessary to fulfill our inflation targeting mandate. And over the following weeks, what we saw was inflation decline as expected and output expand roughly in line with our projection. And we saw financial conditions ease, oil prices stabilized in a range reasonably close to our January projection. And this made us feel increasingly comfortable with the amount of insurance that we had already taken out, which led to the decision to keep rates unchanged earlier this month. Now, the negative effects of lower oil prices are beginning to appear. The positives will take longer to emerge. So we need to watch these competing forces play out in the economy, and the January rate cut has bought us some time to monitor that situation as it evolves. Now, some have characterized this as a move to, quote, data dependency, unquote. Now, I have to say, I find this a bit strange. Data are always crucial in determining how the economy is progressing, and even in extraordinary times, central banks depend on data to help them evaluate how the economy is performing relative to their expectations. And as our economy gradually gets back to normal, we will continue to speak with businesses to get their perspectives. We'll continue to watch the data closely, as we always do, and see how the numbers evolve relative to our forecasts. And we will look to market participants to keep watch on the same data and form their own opinions about what they mean. Our communications focus on explaining how we expect the economy to unfold and being totally transparent about the risks that the central bank is actually weighing. All else equal, this should help reduce the chances of surprising markets. Still, in normal circumstances, it's natural that there would be volatility as economic surprises occur. But we think it is best to have this volatility reflected in prices, in informed, well-functioning financial markets, rather than be artificially suppressed by forward guidance. Allow me to conclude. As we've seen, well-anchored inflation expectations reflect the unwavering pursuit of our inflation goals. They show that market participants continue to believe both in our commitments and our ability to return inflation to its target. Unconventional monetary policies have played a key role in Canada and elsewhere in promoting growth and helping to meet those inflation targets. As the global economy shakes off the Great Recession and the era of unconventional policies comes to an end, a return to ultra-low levels of financial market volatility is unlikely. Bouts of increased volatility can be expected as guidance-influenced positions are unwound and as markets react to shocks. And as we go through the normalization process, this represents the natural reaction of financial markets to economic uncertainty and a return to a normal trading environment, not an erosion of central bank credibility. The Bank of Canada will continue to pursue and fulfill our inflation targeting mandate, and we will continue to follow the policies necessary to ensure a timely return of inflation to target, while of course being mindful of financial stability considerations. Well, this process takes place in an uncertain world where shocks happen daily, behavior shifts repeatedly, and our analytical tools and our models can offer only rules of thumb. And in that sense, monetary policy is a very imprecise business. Less like engineering, much more like risk management. Ultimately, our credibility will hinge on how well we meet our mandate over extended periods of time, and I'm confident that we'll continue to get the job done. Thank you.
We've got some microphones around the room. Governor Poloz has agreed to take questions, so fire away.
Hi, Alan Clark from Scotiabank. Thanks for your speech and coming to London today. Given the depreciation in the Canadian dollar in the last year or so, does that give you some comfort that the underlying gauge of Canadian inflation may not fall like it has done in the rest of the developed world, and perhaps spare you the bother of having to loosen policy again? And apologies for getting technical. Has the Bank of Canada evolved its thinking on a rule of thumb of what a 10% appreciation in the Canadian dollar typically drags 0.5% off of core inflation? Thank you very much.
Well, okay. So, next question. No, seriously, next question. Okay, no, that's unfair. So this is an important point, and I could talk a long time on it, but it's important to understand that when we say, take by illustration the shock to oil prices, when we say we're going to take an interest rate cut as insurance, it's not because measured inflation is going to fall, okay? Because of course it is. It's going to fall everywhere because gasoline and fuel prices go down everywhere. What we're talking about is underlying inflation, which you mentioned, right? So if we look through the idiosyncratic things, such as now energy pricing, some meat prices, global meat prices were high, Canada telecom prices, a few things like this that are kind of oddball one-time effects in the data, and importantly, the effect of the exchange rate. Okay, if we see through all those things, because those things would all be transitory things. What is underlying inflation? Underlying inflation is the thing that is connected to the real economy. The real economy has excess capacity and is growing less than its potential. And so with that, we'll have underlying inflation will tend to go down through time. And so if nothing else happens, that's where we'll end up after all the dust settles. And underlying inflation right now is something like 1.6 or 1.7%. Okay? Which isn't that far away from 2%. But with excess capacity and slow growth, it will tend to drift down through time, and so we'll be underachieving our target 2 years from now. So when we look at the oil price shock, it meant that the economy would take a hit, and that would open up the gap. Unemployment will rise over the next few months. And then, of course, we'll begin to close back in again as the export side of the economy takes over. So that opening of the gap means that our forecast of underlying inflation gets pushed down through the whole profile. And that meant it would take another whole year for us to get back home. Hence, taking out the insurance on the interest rate gives us that. When you look at inflation, even core inflation, what you see then is the effect of the depreciation puffing it up. So it's around 2.1, but you have to subtract that out because it'll go away after a number of months. Now, I've talked long enough. I'm not sure if I answered your question, but I think enough. But I think as for the 10% depreciation versus how much that affects the price level, that does change a lot. That depends. Okay, so that we don't have a hard rule of thumb for that. So we do it in a very micro way, sector by sector by sector. And we do a bottom-up and a top-down analysis to try to reconcile those. And we look at the U.S. inflation data, because then by comparing the same goods in Canada and the U.S., you get the opposite effects, and you get a really good measure of the exchange rate pass-through. So that's a complicated thing to come up with, around 0.4 or 0.3, 0.4, depends right now, but it'll continue to grow because of the depreciation over the last number of months. Okay? I'm sure that gives you enough to go back and figure it out now. So, how are we doing? All right. I can't see anything from here, so.
Hi, Tom Sartain from Schroders. Can I just ask that there seems to be quite a lot of confidence that equilibrium neutral rates have come lower, potential GDP has come lower, yet
yes.
We seem to have inflation targets that haven't come lower. Do you think that maintaining an inflation target that was established when potential growth was that much higher, neutral rates were that much higher, is consistent?
I think it is consistent. It's not entirely a separate matter, as I'll outline. But what that does is it means that the destination interest rate, when all the dust settles, is likely to be a lower number. So our long-run equilibrium, and that's because of those trends that you talk about. But the inflation target can be chosen independently of that. It could be, let's say, still 2%. We are in the renewal cycle. Actually, next year we have to sign a new agreement with the federal government on what the inflation target will be for the next 5 years. And so all that research is being refreshed at this stage. And one of the issues that is raised is if, let's say, you have a world where you have a 2% inflation target and a 2% real equilibrium interest rate, that would mean you'd start the game at around 4% nominal interest rates plus a term premium in the yield curve. Let's say that was where you started. And a big shock comes along, you need to cut interest rates. So you have 4 percentage points of room to cut rates to adjust to that kind of shock, like 2008. But what if the equilibrium real interest rate goes down by a percentage point or something? So then you're starting at 3% instead of 4%. Now you've cut your room to maneuver as a central bank by a whole percentage point. You see what I mean? So that's how the two interact. What we have to ask is, are the risks of another major event of the kind we're living through now, are they diminished enough with all the regulatory reform that we're doing and so on, so that we don't have to worry about that issue? Or should we be more prepared to have more room to maneuver should another big shock come along? And another question which relates to that is zero really the lower bound? And we're discovering that it might not be. Technically, it may not be. You know, remember when Y2K happened, we all thought that 2001 was going to cause everything to break up into little pieces and nothing happened, and we passed through zero on interest rates, and you know, things just kind of happened. But so there's some questions, very heavy theoretical questions around the question you raise, and I don't have answers, except right now I have lots of research going on about them. There's a fellow over here with his hand up. I don't know where we... Okay, one at the back. Okay.
Hi. Jeffrey Yu from UBS. In your last speech, you referred to Deputy Governor Cathay's speech from November last year, where I'll just quote directly. She said, "In exceptional circumstances, particularly if imbalances and excessive risk-taking, blah, 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 monetary policy might have to be used even if it means the inflation would deviate from target for an extended period of time." Does that mean you're willing, in your upcoming mandate renewal, to break ranks with every other G10 central bank by targeting financial stability and sacrifice price stability? Your counterpart in Stockholm yesterday said the Riksbank cannot really afford to worry about house prices right now.
Well, I could just make a short answer, no, because the inflation target is sacred. But what we're really talking about there is in the pursuit of the dynamic, you know, nobody targets an inflation target like I mentioned the central bank in Star Trek, right? So it's not perfect. In the real world, you deviate and then you work at getting it back when shocks happen. And we usually think of approximately 2 years as a reasonable horizon over which to get back. 6 to 8 quarters is kind of our control window over which reacting to a shock gets us back. But the last renewal 5 years ago, which of course was post-crisis, we introduced the notion of flexibility. So it was a flexible inflation target. And the purpose of that was to allow for exactly the case that you're mentioning, that there may be times when, to say, you think, oh, it looks like it's time to do this or that, but right now financial stability concerns are kind of top of the radar, so let's allow that to take an extra 6 months to happen. That's the sort of flexibility that's a conditionality, if you like. So the inflation target would remain front and center, and you would not take a chance of eroding your credibility with it, but you would explain that, in fact, well, we're not being as aggressive as we could be at getting back to target because of some financial stability risks that were present. But we see ourselves as kind of the last resort when it comes to financial stability risks. The financial stability risks are, you know, mainly decided between the borrower and the lender, and behind them there's supervision, and then way, way back is the central bank. And as to me, you know, moving interest rates up or down are not really the tool for tweaking financial stability risk. The best way to fix your financial stability risk is to get the economy back to normal. So generating those jobs and the income consistent with your inflation target means that all those parameters look better when you get there. Once you're out of equilibrium, like we are now, you're kind of trading off, but only in a micro sense, and is what I call in my paper the zone of ignorance. You're hedging one risk versus another, but the primary motivation remains the inflation target. So it's sacred.
Governor Nicholas McLean, Canada-UK Council, you mentioned Basel III in your address. It looks very different from Basel I. And of course, each Basel agreement is a compromise between the different governments and central banks. How do you think Basel IV might look different from Basel III?
Well, this is life. It's a living, breathing thing. And I have no idea what Basel 4, 5, or 6 might look like. But what we know is that as the system evolves, the regulatory architecture has and will continue to evolve with it. What is reassuring is that There is considerable consensus on the basics in Basel III that will mean we have a safer system. When we go beyond that, do we still have room in the financial system in the sense of financial intermediation to innovate, to be creative? Yes, we do. And so I'm satisfied that the economy will continue to get the benefit of that financial innovation without endangering the core payment system or any other financial stability concerns. So, you know, it's impossible to predict. It won't be perfect, and then you know, hopefully nothing bad happens. But along the way, if we see things that look like they're not shaping up the way we'd like to see in a stable world, then there may be attention to more issues. There's a big research agenda on this at the FSB, and it's the best in the world going at that. And it's not our intention to constrain everything, but rather to ensure that it's safe, and that's a benefit to everybody.
Yeah, good afternoon, Mr. Governor. James Athy from Aberdeen Asset Management. Thank you for your time today. I just wondered, I'm afraid I'm going to go back to the inflation target. Do you think that headline inflation target is fit for purpose for an open economy? And in a world of multiple central banks engaging in QE and what appears to be competitive devaluation, how do you, as the governor of a central bank of an open economy, weigh up the domestic versus the international influences? Thank you very much.
Yeah. Well, it is a complicated question, but you know, I still think that is the best thing we've got going. Headline inflation. We prefer to pay most attention to core, because that does take out the biggest exchange rate effects as well as, of course, the energy effects. But there still are exchange rate effects in there. I would just step a little bit aside from your premise, which, you know, I know for some they would characterize what we've been through in the last couple of months as some sort of competitive process. But what I think is the world economy has disappointed us to a degree yet again. We've had a series of what I call serial disappointments in the global economy. Each time we plan on something, we have to ratchet it down, and the same thing has happened in the last few months. And then economies actually, that's a forecast, and economies actually start to see it, as they feel it, it's underperforming. And so, and along came the oil price shock in addition, so that affected some negatively. And so that gives you enough reason to cut rates. And then if somebody else cuts rates and their exchange rate goes down and somebody else cuts rates, oh, that's a currency war or something, which is kind of a silly characterization. What it is a sequence of central banks finding the right place. And in the end, what has happened is global financial conditions or monetary conditions have been eased appropriately, given that the world economy has been downgraded. And it doesn't really matter about the exchange rate effects. They'll work their way out eventually. So you get these transitory effects on your inflation rates because of those things. But, you know, in a year-over-year context, they last for 1 year and maybe a little longer. So what we do is we simply do the calculation and then we see through them. So we talk about underlying inflation because that's the thing that's driven by our domestic economy. And that's the one thing that we can influence. And all these other things are things to explain, but not necessarily things to react to. They're rather things to see through, provided you're sure that they're transitory. Thanks. How are we doing? Oh, well, this is a hot table. This table gets the prize for the most questions. Yeah. By the way, Rob was going to pay me a quid for each question. He said a quid. I'm not sure what that is.
Gilberto Marchegiano, Goldman
I know it's
Sachs.
worth a lot more than a Canadian dollar.
Gilberto Marchegiano, Goldman Sachs Asset Management.
Yes.
I have a question. It seems to me that the big question now for you is the extent to which the non-oil economy will be able to offset the slowdown that will come about as a result of a slowdown in the oil-related sector.
Right.
So I'd like you to make some comments about that and how you see things developing on that front, and how much time do you think we can give the non-oil economy to begin investing more again?
Right. So
before more stimulus might be required in order to support.
Well, great question. Great question. Well, first of all, we can see the effects of the oil price shock already in the Q4 data. So there's already there in consumption, housing, investment, inventories. So we've got evidence already that it started in the fourth quarter. So for our way of thinking of it is like we were basically slotting it in for Q1 and Q2 as the main effects. It seems to have started a little bit earlier in the numbers, and that, of course, suggests a bit more front-loading. Meanwhile, the other side of the ledger is, when do consumers find they've got extra money in their pockets and spend it as opposed to saving it? That we're not sure of. When does U.S. growth, show the effects of lower oil prices, and therefore we get a stronger export profile? And when does the exchange rate effect also cap off that or add to that export profile? And all those things are the positives that are uncertain and take a while for behavior to adjust. But the immediate effects are mechanical. We have 3% less income the day that boat leaves, with the crude in it, or the day it goes out the pipeline. And so that works its way through the system very rapidly. So all that to say that we can see the negative effects. We think we're going to see quite a lot in Q1 numbers. Unemployment's already ticked up, and there'll probably be some more of that. And we've got our fingers crossed about Q2. As we get into the middle of the year, we expect to see the rest being the dominant story. And by the way, the export-oriented, this is a way we split GDP between domestic and export-oriented. Export-oriented GDP is growing by more than 5% right now. So there's some good news under the surface, and that will become the dominant trend once the adjustment to the oil shock and the rest is taken care of. It's pretty significant on the investment side. It's like CAPEX in Canada, over a third of it is related to the oil business. And the companies tell us they're cutting 25-30%, so 10% of CAPEX down, and that's immediate. It's already in the numbers. And then there's the employment associated with that and so on. So it's pretty significant, but it's recoverable, in other words. That the rest of the economy seems to be doing much better, and I think it'll be the dominant story by mid-year. Okay? But that's the idea about buying time to watch those things cross. That's the whole idea. So, if that's yes, we're gonna. I see the little hook coming out. So I want to thank you very much for being here today. It's been a real treat, and I can't wait to come back.